taking Access Bank and Diamond Bank as an example, okay, we can easily look at the scenario before and after. Before now, we had Access Bank and Diamond Bank. And then now, Diamond Bank is part of Access Bank. So we can have various pointers. But basically, I want to quickly buttress my point with the understanding, okay, of the fact that Access Bank, okay, took over the operations of what? Of Diamond Bank at an agreed what value. See, the point I'm trying to make is that it is possible to have other what pointers. It could be acquisition, it could be absorption, it could be unit of interest, okay, but that is not the point. Okay, but the point I'm trying to use these to buttress is the fact that looking at the happenings, the face of what is obvious, you can tell the Access Bank has actually taken full control of Diamond Bank. So it means that it is possible, or permit me to conclude, that Access Bank bought over Diamond Bank. Now, in a situation or in a scenario where you have two going concern businesses and one is taking over the other, we refer to that arrangement as purchase of business. So in this class, we will look at business. Now, this is an arrangement where you have one business or one company taking over the other at an agreed value. So what I'm saying is you can have a company, your friend has a company. Now, it's possible to have an arrangement where your company takes over your friend's company. Okay, so we can refer to it as what? Acquisition of business, or sometimes we refer to it as what? Absorption of business. Now, you see, when you agree to take over a particular company, there's usually an agreed value. And that value is what we call the purchase consideration. So how much are you paying for the business you're taking over? The agreed amount is what we call purchase consideration. Now, cash purchase consideration simply means that the agreed value is to be paid in cash. So if you agree to pay your friend 25 million to take over what? The asset of what? Her business. That 25 million is going to be paid in cash. And that's what we call cash purchase consideration. In this case, okay, you are agreeing to pay the equivalent of the what? Amount in shares. So what I'm saying is your friend agreed that you pay her 25 million to take over the assets of her business. But in this case, she's not agreeing to cash. She's saying that what? The 25 million will be in the form of what? Shares in your own company. That arrangement is what we call what? Shares purchase consideration. I already explained what debenture is in our previous classes. Debenture is a loan what? Arrangement where a company undertakes to borrow funds from an individual at a fixed interest payable over what? An agreed period of time. Now, you can have debenture purchase consideration. So what I'm saying is that you, as the owner of the company, or as the company that is buying your friend's company, the agreed value is going to be what? Paid in form of what? Debentures. What I'm saying is you're not paying cash. You're not giving the person shares. You are converting the consideration into what? A loan agreement at a fixed interest that you pay what? At an agreed what? Period. So that is what we call debenture purchase consideration. You are using debenture as what? The purchase consideration to take over the assets of the other company. Now here we have multiple values purchase consideration. What I'm trying to say is that the purchase consideration is broken into various parts. You have a combination of cash, a combination of what? Shares, and a combination of what? Debenture. So what I'm saying is that you are still taking over your friend's company asset, but the agreed value is broken down into cash. That means you pay some in cash. You pay some with shares of your company, and then you pay some in form of what? The debenture agreement. Goodwill. You will have goodwill where the purchase consideration is what? Higher than the what? The cost of the asset taken over. So the point I'm trying to make is, if the asset of the business you're buying is what, let's say 20 million, okay, and then you agree to pay the person 25 million or even 21 million, so long as the purchase consideration is higher than the cost of the asset you're taking over, you are going to have a goodwill in the book. Now, we have established what? Goodwill to be excess of purchase consideration over the cost of the asset taken over. But where you now have your purchase consideration less than the what? The cost of the tangible asset taken over, then there's a capital reserve. So let's say, for instance, you agreed the purchase consideration to be what? 25 million. What if the cost of the tangible asset is what? Is 32 million? That means the tangible asset cost you're taking over is higher than the what? The purchase consideration agreed. So in that case, you have a capital reserve in the what? Book. Now, in some situation, okay, the business that is buying the other business also helps the business to what? To settle its liabilities. So what I'm saying is that you are taking over your friend's business, okay, and then the agreement is that you pay a particular amount. Now, aside from that amount you're paying, you are also helping that your friend to settle any debt that the company is what? Owing. So in that case, we say that what? You are taking over the liabilities of the company you are what? You're buying. So in this situation, whatever cost of liability you're taking over increases your what? Your purchase what? Consideration. So if you have agreed that you're paying 25 million as what? The purchase consideration. If you're now taking over liability worth another 2 million, it means that your total purchase consideration is what? Is 27 what? Million. So technically, your liability you're taking over increases the what? The purchase consideration. So here we are looking at the reasons for business acquisition. Why would you want to buy a company? Why would you want to purchase a business? Or why would you want to absorb a business? Number one here is what? Is for expansion. Let's take, for instance, the issue or the case of Access Bank and Diamond Bank. Okay, we had Diamond Bank in various other what? Areas. Okay, so with Access Bank now absorbing or buying Diamond Bank, Access Bank will now have presence in those areas where Diamond Bank are or Diamond Bank used to be. So what we're saying is that you can acquire a business basically because you want to have what? Expansion. You want to cover more what? Areas. Another reason is to what? To strategically silence potential business threats. So sometimes you can have a business and then some competitors or competing brands, okay, could be a potential threat. So in order for you to gain market control, okay, you can decide to strategically what? Silence the business by buying that what? Business. Let's take the case of Facebook and WhatsApp as an instance, okay? Remember, the person that, had WhatsApp was not Mark. But at some point, there was an agreement to take over WhatsApp by Facebook at an agreed value. Now, that sort of scenario is a strategic way to still control the social media market. So what I'm saying is that sometimes a business can buy another business to have the control of the what? Market. Especially when you sense maybe a potential threat from that brand. Another reason for business acquisition is what? Is to leverage technical competence. You can have the finance as a business or as a company without having the required technical competence. So another business can have the technical competence without having the what? The money. So a way to leverage on the technical competence of the other business is to what? Is to buy that business over. So that can be a reason for business what? Acquisition. Another one is to keep relevant brand without liquidity operation. Some business brands are very, very important, okay, but they might not have the required what? liquidity for operation. So another way to keep the business or the brand relevant is to what? Buy the business so that it can be operational. Okay, another reason for business acquisition is to save shareholders of significant what? Loss of investment or complete loss of investment. The point I'm trying to make is that if you see a business, for instance, that is not doing so well, okay, a way towards save the investment of the shareholders is to get a bigger company to buy it over. So with that way, or in that way, you have some money or some investment, depending on the arrangement between the company that is buying and the one that is being bought over. Because the idea is that if you as a company that is being bought over, have an arrangement where you have a share in the company that is buying over, your investment is sustained. But if you don't have that arrangement, it is possible that this business crumbles and then you lose your investment completely. So basically, these are some of the reasons for business acquisition. So now I want to look at a scenario where a company is taking over sole proprietorship. A sole proprietor is a business owned by one man. Okay, so this arrangement is that a company is taking over the business that is managed or owned by one person. So what we're saying is that you're going to have a purchase consideration as an amount that the company will pay the owner of the business so as to take over the assets of the business. Okay, this is a question that help us to look at the scenario where a company is taking over a sole proprietor business or a one-man business. Okay, so let's go. The following represent the balance sheet of Kwame Limited. Okay, so we have Kwame Limited, statement of financial position as at 31st December. I told that statement of financial position is also called balance sheet. So we have non-current asset, also called your fixed asset. Land and building here is 800,000. Plant and machinery is 578,000. Furniture and fittings 500,000. Total non-current asset is 1,878,000. We have current asset, debtors and prepayments 400,000. Bank 2,005,000. So if you add everything, you have 2,405,000. So 2,405,000 plus 1,878 gives you 4,283,000. That's the total asset of Kwame Limited. Financed by what? Long-term liabilities, term loan 1,598,000. Short-term liabilities, creditors 955,000. Reserves 178,000. If you add all together, you have 2,731,000. So we have ordinary authorized share capital of 3 million ordinary shares at ₦1 each. Okay, that's for information. So we now have ordinary share of what? 1,552,000. So when you add this to this, you have a total liability of what? 4,283,000. Okay. Now they now say that in 2012, an agreement was reached to take over the business of Kofi Enterprise as follows. So Kwame is taking over the business of Kofi Enterprise. So what they say purchase consideration of 4 million payable in 30% cash, 25% shares, and the balance in 8% fixed debenture for the assets. So this is more like a multiple value arrangement. So Kwame is paying 4 million to what? Kofi Enterprise, but that 4 million is broken down into cash of 30%, shares of 25%, and what? The remaining balance in what? A debenture of what? 8% interest. So the answer, they say all assets and liabilities are taken over at book what? Value. So what I'm saying is that the assets are taken over at the value in which they are in the balance sheet of Kofi Enterprise. So they are saying all assets and liabilities are taken over at a book value, excluding cash. So that means they are not taking over the cash. They say the takeover ended in May 2012. You are to show records of the takeover in Kwame's book. So let's even look at Kofi's Enterprise statement of financial position, which is the balance sheet of Kofi Enterprise. So there's balance sheet of Kofi Enterprise. We have non-current asset, which is the fixed asset. Land and building of Kofi is 450,000. Plant and machinery is 250,000. Motor vehicle is 230,000. If you add all, you have 930,000. Okay, current asset, we have debtors 220,000, cash 85,000. If you add, you have 305,000. So total asset is 305 plus 930, that's 1,235,000. Okay, short-term liability here is 570,000. That's it. Owner's equity 665,000. So we have 1,235,000. So now this is the balance sheet of Kofi. So now we are saying that Kwame wants to take over the assets and liabilities of what? Of Kofi. Now they've given us the purchase consideration, which Kwame paid for Kofi. So that means with that, we should be able to determine the goodwill or the reserve. What is goodwill? Excess of purchase consideration over asset taken over. What is reserve? Where your purchase consideration is less than your what? Asset taken over. So let's go. We have determination of goodwill or reserve. That's the first thing you should do. So what are the purchase considerations? It is 4 million, but we broke it down into what? Cash, 30%, which is 0.3 times 4 million. That will be 1,200,000. Shares, 25%, which is 0.25 times 4 million, which is 1 million naira. 8% fixed debentures, okay, that's the remaining part, 45%, which is 0.45 times 4 million, which is what? 1.8 million. So if you add 1.8 plus 1 million plus 1.2, you have 4 million. I explained earlier that where the business is taking over liabilities, it increases the purchase what? Consideration. So that means the creditors taking over. Here, what are liabilities in Kofi's enterprise? The only liability here is what? Creditors. Okay, so they said that what? Kwame took over the assets and liabilities. So in Kofi's balance sheet, the only item liability here is creditor, which is 570,000. So I told you in our explanation class that what? Whenever the business is taking over liability, it increases the purchase what? Consideration. So we have creditors taken over here to be 570,000. So if you add to 4 million, you have 4,570,000. That will be your total consideration. So what are the assets taken over? They said, the question said what? That all assets and liabilities are taken over at the book value, excluding what? Cash. So what do we do? That means that what? We took over Kwame took over land and building, took over plant and machinery, took over motor vehicle, took over debtors, but did not take over what? Cash. So land, plant and motor vehicle gives us 930,000. That is the non-current asset you're taking here, 930,000. Current asset, only debtors was taken over, that's 220,000. So 930 plus 220 will give you 1,150,000. That's what the asset taken over. So 4,570,000 minus 1,150,000 gives you 3,420,000. So because your purchase consideration is higher than your asset taken over, you have what? A goodwill. So now that we have done that, now we have to now look at the ledgers. Okay, what are the items in the balance sheet of Kwame before the what? The takeover. So what are the items? What would the items be like after the takeover? So let's go. What's the first item in the balance sheet? We have land and building. Okay, for what? Kwame. So we have land and building. I told you land and building is an asset. Assets have debit balances. I already explained that in what? Our double entry class for assets. Go back to the class if you have issues. You can go back to trial balance as well. So now we have balance brought forward. That would be 800,000. That's what we have from the what? Balance sheet of Kwame. Now, Kwame took over Kofi's land and building. What's Kofi's land and building? Go to the what? Kofi statement. You have land and building at 450,000. That will increase it. So when you add it together, you have 1,250,000. So that means the new balance for Lord land and building is 1,250,000. The next one is plant and machinery. Kwame plant and machinery balance brought forward is 578,000. He took over Kofi's plant and machinery at what? Book value. What was it? 250,000. Kofi 250,000. When you add, you have 828,000. New balance is 828,000. Motor vehicle. Is there motor vehicle in Kwame's book? No. But there's motor vehicle in what? Kofi's book. Remember, Kwame took over asset and liability. So Kwame took over the motor vehicle. So we have motor vehicle. Opening balance, nothing. Because Kwame did not have what? Motor vehicle. But Kofi has. So he's taking over Kofi's on 230,000. That's the new what? Value for motor what? Vehicle. So Kwame also took over debtors. What's the debtor balance from what? Kwame. Balance before is 400,000. Look at it here. 400,000. So what is the asset taken over from what? Kofi. Debtor here is 220,000. That's it. Kofi 220,000. When you add, you have 620,000. New debtor value for what is what? 620,000. Kofi also took over creditors. Creditor is a liability. That's the credit balance. Okay. Balance brought forward. Kwame's creditor is what? Kwame's creditor here. Look at it here. It's 955,000. That's the balance brought forward. You have here 955,000. Kofi's creditor is what? 570,000. So when you add, you have 1,525,000. So a new creditor after the takeover will be 1,525,000. So what do? We prepare the balance sheet. We now have Kwame's new balance sheet, Kwame Limited, statement of financial position as at 31st May 2012, which is the date that they concluded the takeover. So what's our new land and building? Look at it here, 1,250,000. What's our new plant and machinery? 828,000. What's our new furniture? Okay. What's our new furniture? Furniture is 500,000 because there's no furniture taken over in Kofi's book. So we have 500,000. What's our new motor vehicle? Motor vehicle is 230,000. Okay. Kofi had motor vehicle, Kwame did not have, but Kwame took over Kofi's asset. So motor vehicle is 230. When you add all together, you have 2,808,000. So the current asset taken over now, new value for debtors and prepayment is 620,000. Remember, there was an adjustment because the debtor in Kwame's book is 400,000. The debtor in Kofi's book is 220,000. When you add together, you have 620,000. So the bank now we reduce because we paid Kofi in cash. How much did we pay Kofi in cash? 0.3. That's 30% of 4 million, which is how much? 1.2 million. So how much did Kwame have in bank? Go back to the statement. Kwame had 2,005,000 in bank. He paid Kofi 1.2 million. So that means the bank balance will reduce 2,500,000 minus 1.2. That's what? 805. So 805 plus 620 gives you 1,425,000. So this plus this is what? This plus this is part of the total asset. But there was a goodwill. Remember, the purchase consideration exceeded the cost of asset taken over. So we had 3.4 million, 3,420,000. So our goodwill here is 3,420,000. So 3,420,000 plus 1,425 plus 2,808 gives you what? 7,653,000. Financed by, what's the long-term liability? In Kwame's book, 1,598,000. You bring it, there's no adjustment. Kofi also got a debenture in the agreement. Remember, the 4 million was paid 30% cash, 25% shares, then 8% debenture. Debenture is a long-term liability. So 8% debenture, 8% fixed debenture is the balance of the of the 4 million, which is 45% of 4 million. Okay, so that will be 1.8 million. Short-term liability, our creditors has increased to 1.525,000. Okay, so when you add plus the reserve you have in the question or in the balance sheet of Kwame before the acquisition, when you add 178,000 plus 1,525 plus 1,800,000 plus 1,598, you have 5,101,000. Then we now have the ordinary shares. Remember that Kwame also paid Kofi in shares, which is 25% of the total value, which is 25% of 4 million, which is 1 million. So we have ordinary shares, which is 1 million that Kwame has, 1.552 that Kwame has, plus the new share issued to Kofi, which is 1 million. So when you add, you have 2,552,000. So 2,552,000 plus 5,101,000 will give you 7,653,000. That's the total liabilities equal to your total assets. Now we're looking at company taking over partnership. So we already know that sole proprietor is owned by one person. Partnership is owned by 2 or more individuals. So in this case now, the company is taking over Partnership. So it's the same way, okay? The same way we deal with one-man business, because you have to pay the partners, okay? There has to be a purchase consideration. But the only difference is that whatever you're paying the partnership is shared among the partners in an agreed ratio. So that's an agreement between the partners. But the procedures of taking over a partnership business is technically the same thing with the procedure of taking over one-man business. So now here we're looking at company takeover company. So the arrangement is that a particular company is taking over another what? Company. Okay. So usually what happens is that the company that is taking over the other company either gives a purchase consideration, okay? And like I said earlier, you can have purchase consideration in cash, shares, debenture, or a combination. Okay, so what happens is that when you pay the new company in cash, shares, or debenture, that company that you purchased, okay, is liquidated, just like the case you have between Access and Diamond Bank. The moment Access Bank took over Diamond Bank, you see Diamond Bank is no longer an entity on its own as such. So if you have any issue with Diamond Bank, you have to refer to what? Access Bank, that sort of scenario. So that is what we have by company taking over our company. But what I am trying to say is that where you have shares, okay, issued to the company that has been taken over, what happens is that you liquidate the company, you now share you distribute the shares among the shareholders, or you sell the shares, get the cash, and then distribute among the shareholders. It is also possible, okay, for the companies to exchange shares. That is to say, instead of purchase consideration, the purchasing company exchanges its shares with the company that is being purchased. Okay, so you have some share exchange or debenture exchange between both companies. But that is not what we are concentrating on in this volume. In this volume, we are concentrating on takeover by purchase consideration. So in our volume 2, we look at other aspects of company taking over companies. So this is a quick question, okay, explaining a company taking over another company. So what we have here is the following represent the balance sheet of Raya Limited. So Raya Limited, we have Stone of Napoli as at 31st March 2011. Non-current assets, you don't know what they are. Land and building machinery. We have 1.81078. So we have 2878. Current asset, they have debtors and prepayment 400,000. Bank is 2,005,000. When you add all together, you have 5,283,000 as total assets. Financed by long-term liabilities, we have long-term loan 1,598. Creditors 955,000. Reserve here is 1,178,000. So we have 3,731,000. Ordinary share is 1,552,000. So when you add together, you have 5,283,000. Okay, now this is what happened. They said in 2012, an agreement was reached to take over the business of Dede Limited as follows. Purchase consideration of 1.1 million, payable in 20% cash, 80% shares at par. So here we have the purchase consideration in cash and in shares. Okay. Now they now said all assets are taken over at 90% book value. So they didn't take it 100%, excluding cash. So the takeover ended in May, and Dede Limited settled this liability. That means that Raya did not take over Dede's Limited's liability. So Raya only took over the tangible assets. Dede is to settle his own liabilities. So they're not saying you have to show the record of takeover in Raya's Limited book. So now where is even the book of Dede? So I will know the book value of the asset taken over. So this Dede's balance sheet. State of the position 31st December 2011. So Dede has plant and machinery, furniture 450,480. That's 930. He has debtors 300. He has cash 105. Okay. So 930 plus 405 will give you 1335. Then he has a short-term liabilities, creditors 370,000. His ordinary share capital is 965,000. So we have 135,000. So let's determine goodwill or reserve. So what's the purchase consideration? We have cash and shares. Okay, 20% cash, 80% shares. Total value of consideration is 1.1 million. So cash is 0.2 times 1.1. That's 220,000. Shares is 0.8 times 1. That's 880,000. So total consideration is 1.1. Remember, he's not taking over liability, so you can't bring that in here. Only when the company buying is taking over liability, that's when you bring it here. In this case, Raya is not taking over liability, so you cannot bring it here. So we have total consideration to be 1.1 million. So what are the assets taken over? Non-current asset here is plant, machinery, and furniture, which is 930,000. Remember, they said they took over. Raya took over the asset at 90% of the book value. So what's 90% of 930? 90% of 930 here is 837. He also took over debtors, but he didn't take over cash. So what's 90% of debtors here? 270,000. So 837 plus 270 is 1,107,000. As you can see, the purchase condition is less than the what total asset. So there's a capital what reserve. So let's quickly pick up the items in the balance sheet of what Rhea and then adjust for what the ones taking over. This class continues in the next part. So we have a part 2 of this class. So join me in the part 2 class so we can wrap up a company taking over company. That's Rhea Limited taking over Dede Limited.